Now for something really sexy. Richard Kaufman. Richard is the New York State Chair for Energy Policy and Finance. Beat that one, Richard.
Really unfair to follow. So I'm the state energy czar. We know what happens to czars. But before that, I spent 30 years in finance. And so I want to talk about impact investing in energy efficiency and renewable energy projects. In particular, I want to talk about debt, and I want to talk about the use of a particular kind of state government public-private partnership. And like a lot of states, or virtually all states and governments, we have limited resources, and we need and want to do more. So I want to emphasize a theme that's come out already, which is that the problem is not liquidity or returns of investments, and it's not that we need subsidies, and governments have used too much subsidies. It's really about removing particular kinds of market gaps that inhibit money, which is looking for a yield. And so renewable energy projects, they pay a yield, and that's what investors want. But there are obstacles that prevent the money from flowing from where it is needed to where it is wanted. So the New York State Green Bank is going to be $1 billion. The first bit is $200 million. What's the funding? The funding comes from essentially a surcharge that currently exists on everybody's electric bills in the state of New York. And so the money is going to be redirected from existing subsidy programs, some of those subsidy programs, to capitalize the Green Bank. The strategy of the bank is to work to remove market gaps in financing. And that's the justification, of course, for a government to get involved in the banking business or the finance business. It also gives the opportunity to earn a rate of return, because we want to earn a rate of return. So what are the two market gaps? Well, bank capital and insurance company rules make it difficult to lend to smaller projects, to things that are marginal or below investment grade, or things that have a long maturity, or anything that has a whiff of something that's new. That's why when we all land at airports and look down and see flat rooftops of warehouses, you don't see solar installed. It's not because the projects are not economic, it's because they're not financeable. The second gap relates to the relative lack of use of capital markets. So that's not how we don't use stock and bond markets broadly in the renewable energy efficiency world. So if you don't have stock and bond markets, and you have limits to bank lending, you have market gaps. So we're going to work on a wholesale basis with intermediaries. Wholesale means we don't think governments are so good working with individual borrowers. So with those intermediaries, they could be service providers, they could be project developers, they could be manufacturers, they could be financial entities that are making progress with customers but face financing gaps. So as a result, their progress with customers are limited by the lack of availability of financing, not by the cost of financing. We do not want to be in the subsidy business. If you're in the subsidy business, you give away your money, you don't get leverage, and you're not moving markets. And if you got to move markets if you want to make a difference here. So we'll eventually need to find a financial institution that, say, in exchange for some sort of credit enhancement from us, we're taking away some of the risk, a financial institution will lend more than they would otherwise. So you might want to think about it as being one standard deviation away from where financing markets are today. So I hope you can see the leverage of the model and why it's a better use of ratepayer funds than some existing programs. We're leveraging the private sector lending, so do more than otherwise. Second, once a market is established, and we're talking about commercial markets, the Green Bank can get out of the way. If we can find commercial opportunities, we can actually sell down our position, and we can turn over our balance sheet, and we expect to be paid back, which means that in contrast to a subsidy where the money's gone, we'll have a continued capitalization that will continue to lend. So we want to work on areas where we can also accelerate creation of capital markets. As an example, this is kind of nerdy, but it gives you a flavor. We can offer a warehouse for securitization, and some banks have told us that it's expensive. We could work with an insurance provider that wants a reinsurance product to give a credit wrap. and we can work on standardized contracts, if that would be helpful. Thanks.